This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. And straight ahead on the program, a look at Tuesday's U.S. presidential election and what could be at stake for the U.S. economy. Also, a preview of this week's Federal Reserve policy meeting. I'm Tom Busby in New York.
I'm Stephen Carroll in London. We're calculating the size of the Bank of England's budget headache.
I'm Charlie Pellet, looking ahead to earnings from some of Japan's biggest automakers and the state of the gold trade.
That's all straight ahead on Bloomberg Daybreak Weekend. The business news you need to wrap up your week. Available on Apple, Spotify, the Bloomberg Business app, and everywhere you get your podcasts.
Good day to you. I'm Tom Busby. We begin today's program with this Tuesday's U.S. presidential election and what each candidate, if he or she wins, is hoping to do for the economy. For more, we turn to Mark Niquette, Bloomberg Real Economy team reporter. Mark, thank you for joining us. Well, we're getting down to the wire. Right now, this election looks like a toss-up. Just a few key swing states likely to decide the outcome. I'm going to ask you where the economy is right now. One candidate calls it a disaster. I don't think that's true, but why don't you tell me where we are now?
We kind of have a disconnect between an economy that economic indicators show is doing well and is strong, and public perception as measured by polls that the economy is headed in the wrong direction. We had a spate of economic reports this week that would be otherwise you'd think encouraging for Kamala Harris, showing that the economy is doing quite well. We had a GDP report yesterday that showed an annualized rate of 2.8% in the third quarter. Consumer spending was up. On Tuesday, we had a consumer confidence report showing that consumer confidence increased in October by the most since March 2021. And we had a PCE report, so-called core personal consumption expenditures, that showed that overall inflation was down to 2.1%, the lowest since early 2021. But despite these good economic numbers, polling continues to show that voters think the economy is headed in the wrong direction. They're still stuck on, high prices and, a sense that inflation rate that we've seen come down hasn't translated into their everyday purchases of gas and groceries. So that's sort of the backdrop for the presidential election, where we have a race where voters say the economy is their biggest issue, and polls, including our poll with Morning Consult, show that voters trust Donald Trump, more than Kamala Harris on the economy.
Well, because of that, let's talk then about what each candidate is promising to do. You're right. Former President Trump, many believe he handled the economy better. Right now, though, it seems to be banking on punishing import tariffs as his chief economic plan. Tariffs certainly have their benefits, but is this really going to move the needle on inflation and household budgets?
Well, if you talk to most mainstream economists, they'll tell you yes, that there's even forecasts out there that will calculate what impact the proposed tariffs that former President Trump has promised on the campaign trail, what impact that would have on the increase in inflation and decrease in gross domestic product. The expectation from most economists is that when you put a tariff on at the size that President Trump is talking about, 10 to 20% on all imports and 60% on imports from China, that's just going to drive up prices because foreign countries don't pay the tariffs. Importers pay the tariffs, and they're passed along to consumers. So the rising prices will, some economists predict, will lead to even stagflation. Now, the former president and his supporters would argue that the inflation didn't spike during his first term when he put in tariffs on China and aluminum and steel imports, and that their projections are that the tariffs will actually help with reshoring of manufacturing and creating of manufacturing jobs in the U.S. and actually increase economic growth. So we'll kind of have to wait and see if former President Trump wins and he does put these tariffs on, what impact they would have. Because while his supporters say that there wasn't a spike in inflation during his first term because of the tariffs he put on, what he's talking about enacting if he is elected to another term is substantially higher and broader. Essentially, his proposed tariffs would hit all $3 trillion of U.S. imports annually. That would have
staggering.
Presumably a big impact on the economy.
Vice President Harris has promised to tackle the high cost of living by boosting new home construction, going after corporations accused of price gouging, and expanding a tax credit for those with young families. And to pay for all that, of course, taxes on the wealthy. What would that mean for inflation and for the economy?
Well, that's going to be the big fight next year over taxes. We have the tax cuts that former President Trump enacted when he was in office in 2017 that are expiring at the end of 2025. So the next president, whether it's Kamala Harris or Donald Trump, and the newly elected Congress, will have to deal with taking action on those expiring tax cuts, either extending them as President Trump has talked about doing, or changing them as you mentioned, Kamala Harris has talked about, Vice President Harris has talked about. She's suggesting that the tax cuts should be limited to those making $400,000 or less a year. So preserve the tax cuts for middle class, but allow increases for wealthier individuals and increase the corporate rate to 28% as a way to, as she would say, have the wealthy and corporations pay their fair share, but also to raise revenue to pay for, as you mentioned, expanded child care tax credit for first-time home buyers, and some other subsidies that she's proposed for small businesses. But that's all going to be up to Congress. And one of the things we'll be watching to see, what kind of party control of Congress we see after the elections on Tuesday. We have a potential for a president elected with full control, party control of Congress, or divided government. And that will go a long way determining, what happens with the tax bill.
Yeah, you bet. Well, a lot to look forward to. Election Day, Tuesday, November 5th. Our thanks to Mark Niquette, Bloomberg Real Economy team reporter. Well, we turn now to the Federal Reserve as policymakers meet again this week on interest rates. For more on what to expect, we turn to Stuart Paul, U.S. economist with Bloomberg Economics. Now, Stuart, Fed Chair Jerome Powell has always maintained that FOMC decisions are data-driven, and wow, did we get some kind of data point this past Friday. Just 12,000 jobs added in October. Was this a shock to you, and what does it mean for the Fed?
We had anticipated actually a slightly worse jobs report. We'd expected total employment to actually decline by about 10,000 jobs. Private employment did decline during the month. A big part of that is the effect of both Hurricanes Milton and Helene, and also the strike at Boeing. We did see about 45,000 jobs lost in manufacturing, and we think that that's mostly a consequence of the strike at Boeing and knock-on effects at parts suppliers. The household survey, where we see the unemployment rate, actually worsened just a little bit. Now, the headline unemployment rate held steady at 4.1%, but that's mostly just a matter of rounding. It's literally just a matter of a few hundredths of a percentage point that is getting rounded away, and that's keeping the unemployment rate at 4.1%. But the actual numbers do look a little bit worse when you look under the surface. Undoubtedly, the labor market is cooling. We also saw earlier last week the total number of job openings declining during the month, and the quits rate falling as workers realize and as they come to grips with the fact that it is more difficult to find new employment at higher wages. The Fed is absolutely going to be taking this cooling labor market into consideration when it meets next week to make its next rate cut decision.
Now, on the other hand, we have seen some very encouraging economic data as well about GDP, consumer spending, consumer sentiment, and inflation, right?
That's right. So core PCE inflation, the Fed's preferred gauge, came in a bit hot in September. And yes, you're right, through the third quarter, we did see pretty strong growth, 2.8% annualized growth on the back of about 3.7% annualized consumer spending growth. Now, when we drill down into the data, it looks to us like it's mostly employment and employee compensation income, so wage income, that's supporting that spending, and just an exceptionally low saving rate that it just consumers under saving to support their spending habit. As the labor market cools, we think that under saving is going to go away. Consumers are going to get a little bit more cautious. And so a lot of those tailwinds that have been supporting spending, we think are going to fade as the labor market cools. So yes, for now, things do look rather strong. They look strong through the GDP numbers. But I think that if you're thinking like the Fed and you're thinking about what it's going to look like down the line, it's time to get a little bit more cautious and to think that some of those tailwinds might be fading.
And the Fed still has another meeting in mid-December, right? So what's your gut feeling right now after, in the wake of this jobs report, dismal report, of what the Fed is going to do?
We think that the Fed is going to cut by 25 basis points. So still another rate cut, still the removal of restrictive policy, not quite getting back to neutral, certainly not accommodative, but a 25 basis point reduction for November. Looking ahead to December, we still think another 25 basis points is in play, but for a data-dependent Fed who's probably going to then slow down its cadence of rate cuts in 2025, December is going to be more of a knife-edge decision. We'll need to see just how much the labor market deteriorates between now and then.
Mortgage rates, though, have moved the other way. Why is that? And I mean, it's really got to affect housing and people's affordability. But why have we seen 6 weeks in a row mortgage rates edge a little bit higher?
Mortgage rates tend to be benchmarked based on longer-term Treasury rates. So the Fed is cutting very, very short-term interest rates. And in fact, by running off its bond portfolio, it's putting upward pressure on long-term rates, all at a time when we have an election coming up where the two candidates are spending heavy versus spending heavier. There is no austerity candidate. So I think that the bond market is looking at our fiscal situation as a country, and they're also feeling the effects of the runoff of the Fed's balance sheet. And we're getting some upward pressure on long-term yields, and that's pushing up mortgage rates. Again, we think that higher long-term rates, higher mortgage rates, tends to put people in a little bit more of a bind. So even as the Fed is cutting short-term interest rates, folks are probably going to need to rein in spending just a bit more, especially as the labor market cools.
Yeah, well, when it's cooling. Well, that two-day FOMC meeting kicks off Wednesday, delayed a day because of the elections. Decision expected 2 p.m. Wall Street time on Thursday. And our thanks to Stuart Paul, U.S. economist with Bloomberg Economics. Coming up on Bloomberg Daybreak Weekend, a look inside the inaugural budget of the UK's newly installed government, what that means for the Bank of England. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. Up later in our program, a look ahead to earnings from some of the world's biggest automakers. But first, the UK's new Labour government has delivered its first ever budget, boasting one of the biggest tax increases in a generation and changes to the nation's much-touted fiscal rules. What will the country's new economic direction mean for the Bank of England? For more, let's go to London and bring in Bloomberg Daybreak Europe anchor Stephen Carroll.
Tom, the UK's Chancellor of the Exchequer, Rachel Reeves, unveiled a £40 billion package of tax rises and ramped up borrowing in a dramatic move to meet the Labour Party's pledge to rebuild the UK. Well, one person who'll be keeping a close eye on the developments announced by the Chancellor is the Governor of the Bank of England, Andrew Bailey. He and his fellow policymakers are due to make their next interest rate decision in the coming days, just shortly after the budget announcement. Although officials have already opted to lower borrowing costs this year, economists are warning that the pain of high rates could be prolonged following Reeves's announcement. It's thought the government plans to lift borrowing by £142 billion over 5 years to help fund a massive programme of investment and boost public services, coupled with a pledge to deliver another large jump in the minimum wage, are potential threats to the BOE's aim to keep inflation low. We discussed how Reeves's plan might affect personal spending habits with our money distilled columnist John Stepek. Here's what he had to say.
I don't get it wrong. I mean, I think that the direction of travel has been very clear on property for a long time. And I think if you're someone who still views residential property as a viable investment for an amateur person, or even as an investment asset, you maybe need to have a look at what's happened over the last 10 years because the tax benefits have been slashed. This latest move, jacking up the stamp duty again, is just It's sort of signalling we don't want people to own second homes, and that's before you get to local council taxes in various desirable areas. I mean, the other rabbit obviously is basically saying
things
that
that didn't happen.
We'll defrost the tax thresholds in 2028, 2029. But of course, she's got 5 years to change her mind about that.
Yes, it's a long way off.
That's Bloomberg's John Stepek there. So will government policy leave the central bank wary over the pace of further rate cuts? It's something I've been discussing with Bloomberg's chief UK economist, Dan Hansen. Give us some context. What has the budget changed for Andrew Bailey and for BOE policymakers?
If you go back to the middle of September, I think it was, or not long after the September meeting, Andrew Bailey gave an interview saying that policymakers could be a little bit more aggressive in terms of their speed of rate cuts. I think the budget makes that quite unlikely now in terms of how quickly they ease. I think the sort of the baseline case and a reasonable base case is that they make a move down in November, but they stick to the mantra that things will be gradual. So they're not going to indicate, I don't think, that they will speed up the pace of rate cuts. For that to happen, the data's going to have to really surprise. And it surprised a bit to the downside, but it's not really surprising to the downside. And as you just mentioned there's this enormous fiscal stimulus that needs to be factored into their thinking now, and the national minimum wage hike as well. And that just is just one more reason to think that they're going to move slowly.
Let's dig into the borrowing picture and what we learned after the budget from the independent government watchdog, the Office for Budget Responsibility, that kind of crunches the numbers around the announcements being made by the Chancellor and puts them in a long-term context. What did they say exactly about what that spending would mean for the inflation outlook and thus the outlook for interest rates?
Yeah. So they said that there would be the way the policy package has been set up, there will be this relatively large near-term boost to the economy. So growth next year could be 0.5 percentage points higher as a result of the policy package, which is a significant
good news, surely.
Yes, It's very significant when you're forecasting growth of sort of 1-ish%. If you're going to add sort of 0.5 percentage points to it, that's quite significant. So. And the thing to remember about the Bank of England, which is slightly different to the Office for Budget Responsibility, is that the Bank of England thinks the economy's speed limit, so the speed at which it can grow without stoking inflation, is low, or lower than the Office for Budget Responsibility, I should say. So the Bank of England thinks the economy can grow 1 to 1.5%, somewhere in that range, a year without inflation taking off. So if you add in, as I say, the stimulus next year, that is good, and with an economy operating pretty much sort of at full employment, full capacity, there is going to be an inflationary impulse from it, maybe 0.2, somewhere between 0.2 and 0.4 on CPI inflation over the next 18 months or so. So that's, it's a significant boost.
So for the outlook for rates, then, what does that mean?
So I think, as I say, I think they're going to cut interest rates at the upcoming meeting. I think that's sort of pretty much a given, but I think there was always a question about whether this meeting they would open the door to going a little bit faster if things allowed them to. So essentially creating some conditionality in how they'll sort of respond going forward. I think the chances of that now have dropped dramatically, and there was a lot of debate in the market, and a lot of clients I speak to are sort of there's a lot of debate about. Was a lot of debate about December, whether they cut again in December, particularly with what's going on at the ECB, potentially the Fed going twice before the end of the year. I think the budget has made that significantly less likely that they go again in December. I don't think you can preclude a speeding up next year, but it'll really be about the data. I think if you're sat on the Monetary Policy Committee over the next week or so, and you're going to make your decision, which is announced on the 7th of November, you will feel that the inflation picture's become a little bit more cloudy as a result of the budget. So I think for this upcoming meeting, the cautious tone will continue.
I mean, you wonder as well whether people in Threadneedle Street were holding their head in their hand, thinking they have to rethink all of the work they'd done before in terms of projections for the economy with everything that happened in the budget, because it was a big package. We expected it to be, because it had been it's the first under this current government in the UK. But I mean, is it kind of further down the line, if we think past the upcoming meeting, is there a lot in there for the Bank of England to have to try and calculate the effects of down the line? You mentioned the national minimum wage increase coming. That's, of course, a wage inflation issue. We've got the increased payroll taxes on employers for the national insurance contributions as well. That could shift the path for where the Bank of England goes.
Yeah, absolutely. I mean, I wouldn't, I said that I wouldn't like to be in Threadneedle Street, as you just said, watching that budget and sort of making a decision about interest rates. I also wouldn't like to be in Threadneedle Street putting the forecast together, which is what they're going to have to do in pretty quick order because it would be it's very unlikely that the forecast that gets published won't have this impact in it. So the bank's going to have to work pretty quickly to get it all incorporated. I mean, I think they would have been surprised. Bottom line, to sort of go to your point, I think they would have been surprised by the site. They would have known there was going to be some stimulus coming. I think the scale of it will have surprised them. So yeah, and I say, going back to how that will sort of be reflected in their communication, I think, cautious guidance, but also it's quite possible that we don't get all of the committee voting for a cut. Again, right. you get another split vote. I think it.
Remind us of where we were last time around. With
so in September it was 8-1 for a hold, and I think the way the data had been moving, there was a real possibility that we got a 9-0 in favour of a cut in November. This is all prior to the budget, and I think that in itself may have sort of sent a signal that the idea of a December cut was on the cards, or a possibility and something that was being seriously considered. Now I think you'll most likely get at least one, possibly two of the more hawkish members of the committee saying, this has changed my thinking again, particularly with the national living or national minimum wage increase. So, all of it's going to have a significant bearing on how the bank communicates its latest decision.
Yeah, it makes the job much more complex as well. Just cite us where the BOE is in the sort of the global landscape of this as well, because obviously we had the big rate cut from the Fed, and the ECB's been proceeding kind of fairly steadily along the line as well. I mean, is it going to get into a sticky situation for the BOE if they're not cutting next month and everyone else is rolling forward on cuts? Not, of course, if that's something that we can bet on either.
Yeah, I mean, there's always that, isn't there? The sort of the disconnect between global central banks. I mean, I think, you look at the US and we'll get jobs numbers and the like, but, the US economy's been holding up pretty well as well. I mean, the European economy does look weaker than it sort of, I think people thought sort of 2 or 3 months ago, and that's why the ECB is going sequentially.
Yeah.
I don't think it's a huge deal if the bank doesn't follow them one for one. They did, obviously, on the way up, it was almost sort of matched what all of them did. Slightly different speeds, but pretty much the same. I think on the way down, I think the idea that the UK's inflation problem probably is a little bit stickier still holds. So I think the bank probably will be a bit more cautious about how quickly they cut rates. You've got, as I say, in Europe, you've got definitely evidence of a weaker economy. In the US, they have a slightly different mandate, which people place different weight on this. I place quite a lot of weight on it. It just makes it easier. If you see some signs of cracks in the labour market, you can just focus on that a little bit more. The bank is just in an inflation targeting central bank. That's its mandate. So I think it just is going to move more gradually. And for us, that means at a quarterly pace over the course of 2025.
And rates staying a little bit higher on the long term or the medium term, is that a likelihood as well? Or possibility, I should say?
Yeah, I think so. I mean, there's this huge debate, isn't there, globally about where rates will eventually settle, the neutral rate, as people call it, the rate that sort of doesn't speed up or slow down the economy, the sort of equilibrium interest rate in the economy. It's undoubtedly higher than it was sort of prior to the pandemic. Is it as high as it was prior to the financial crisis? Probably not. But I think the weight of evidence, given that economies have been, in the face of the tightening that we saw, economies held up pretty well, given what was thrown at them. The evidence is it is, in our view, somewhere probably between 3 and 4%. So somewhere in that range, knowing exactly where it is very difficult. But if you just sort of split the difference around 3.5, maybe our forecasts, they go all the way down to 3. So, but it's very uncertain. I think the bigger picture is that it is not. We're definitely not going back to where we were sort of during the pandemic, but even prior to the pandemic of basically zero interest rates.
Okay, Dan Hansen, our Chief UK Economist, thank you so much for joining us. And of course, we'll have full coverage of that Bank of England decision when it comes on Thursday across our Bloomberg platforms. I'm Stephen Carroll in London. You can catch us every weekday morning here for Bloomberg Daybreak Europe, beginning at 6 a.m. in London and 1 a.m. on Wall Street. Tom?
Thank you, Stephen. And coming up on Bloomberg Daybreak Weekend, an earnings preview from some of Asia's biggest automakers. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. Japan, known for its massive auto industry, which accounts for 22% of that nation's total exports. And this week, we'll get a number of key earnings reports from that sector. For more, we turn to Bloomberg's Charlie Pellet, who's anchoring the Daybreak Asia podcast this week.
Tom will get earnings from some of Japan's largest automakers next week, including the likes of Nissan, Honda, and Toyota. And joining us now for a closer look, Tatsuo Yoshida, Senior Autos Analyst for Bloomberg Intelligence in Tokyo. Set the landscape for us. What is the backdrop heading into these earnings reports?
Actually, macro environment is pretty much mixed. And then also regional automobile market is also mixed. The macro-wise, material prices is easier than before. And then yen is now coming back to the weaker side. This is obviously positive. However, inflation is persistent, such as wages and then logistics costs. Those are higher than before. Commenting on the regional automobile market, Japan is recovering from the impact of the output cuts due to the certification scandal. And then U.S. market, the market is kind of stagnant, but strong Japanese makers are still have a room for growth. And then China, overall market is gaining momentum due to the government support, but Japanese automakers are struggling, mainly because of the lack of popular new energy vehicles, which is basically battery electric vehicles and plug-in hybrid vehicles.
All right, so company by company, let us begin with Toyota, the world's top car maker. What are we looking at there?
The company-wise, also situations are mixed. Toyota, and then together with Honda, those two companies are ahead of their guidance. Toyota, for example, their sales in Japan is stagnant because of the certification scandal, but sales in U.S. and then sales in India or other part of the Southeast Asia countries, their sales are very strong.
And Nissan Motor, what are analysts expecting there?
Nissan, I think they are behind the guidance. And then market is a little bit cautious about the company. And despite the weakening yen lately, there still remains a possibility of the guidance downgrade.
How does the global shift to electrification play into these coming reports?
Actually, the electrification is diverse, not just battery electric vehicle, but also the hybrids. Plug-in hybrids are also a big part of the electrification. Japanese a little bit behind battery electric vehicle advancement. However, they are ultra strong in hybrid electric vehicles. And then I think hybrid electric vehicle sales at Honda and then Toyota are strong and then driving their earnings. Actually, Toyota, Honda, they are gaining a lot of profit from their hybrid vehicles.
A quick question about tariffs, either declared or potential, involving Chinese-made EVs. Do Japanese automakers expect to see any potential gains because of tariffs imposed on Chinese vehicles?
Actually, Chinese and Japanese are not competing head-on outside of China. So the tariff thing, of course, that may benefit the Japanese a little bit, but not significantly.
And as we get these earnings reports, is there any one of the three, Nissan, Honda, or Toyota, that might stand out as an industry bellwether?
I would expect Honda may upgrade their full-year profit guidance.
Tatsuo, we thank you. Tatsuo Yoshida, Senior Autos Analyst for Bloomberg Intelligence, joining us from Tokyo. We move next to the hottest commodity on the street, gold. The precious metal is trading at records, extending a surge that has sent gold up over a third this year. And joining us now, George Milling Stanley, Chief Gold Strategist at State Street Global Advisors. He's in our Hong Kong studio. So, George, with gold at a record, what is it that got us here?
I think there are really three things that got us up here. The first is that central banks have been very significant buyers of gold now, primarily central banks in the emerging markets, buying gold because they didn't have enough in their official reserves. And that's been a process that's been going on for 14 straight years, not going to go away anytime soon. The second thing, we've seen a big revival in investment demand in China. I think Chinese investors responding to problems in the stock market related to real estate and turning to the traditional alternative, which has been gold for a very long period of time. And then for different reasons, we've seen a revival in Western world investment, Western Europe and North America, concerned about macroeconomic issues and also concerned about geopolitical issues. I think that combination is what's driven gold up to a whole succession of all-time highs this year.
Well, does the current price of gold then justify current valuations?
I think it does. I mean, you know, if you think about it, the kind of macroeconomic scenario that we're in, with inflation still being sticky, especially on the Fed's preferred measure, and with the Fed having started to cut interest rates and clearly embarking on a sustained period of rate cutting that's going to run through next year, if everybody's to be believed, that I think is likely to lead to dollar weakness and then consequently gold strength. And then the geopolitical background, a conflict in Europe with the potential to turn nuclear at the push of a button, and the Middle Eastern conflict having now spread way beyond Israel's borders, where it was confined at the beginning, and now including open warfare with Iran and Lebanon, and the potential for that to get even worse. I think all of those things together historically have been very helpful for gold, and right now they're continuing to be very, very supportive, which is why we keep hitting this succession of all-time highs.
Well, let me throw in one more piece of uncertainty, and that is the American presidential election. Potentially, what might that mean for the price of gold?
I'm guessing that whoever becomes the president, we're going to see continued spending, whether it's spending on domestic programs from the Democrats or whether it's spending to finance, or whether it's tax cuts. We're going to see bigger deficits whoever becomes the president, and that I think is going to lead to further dollar depreciation and quite possibly a renewal of inflation, which could be really very, very damaging at this point. As long as we avoid the dreaded trifecta, as long as we avoid one party getting the presidency, the House, and the Senate, which I think has always led to extremism in the past, I think that as long as we get the checks and balances that the U.S. system is designed to incorporate, then I don't think that there is anything likely to be bearish for gold in there at all. My sense is that, you know, with likely increased spending, likely increased deficits, I've been hearing for 20 years that our deficit is unsustainable, and we keep sustaining it somehow or other. I think that all of those things are going to lead to dollar depreciation, and that should lead in turn to a stronger gold price.
What happens if we don't quickly know the election outcome? How might that play into the price of gold?
I think all that would do, and I think there's a very real possibility of that given the way some of the candidates are talking. I think that all that would do is simply add to the general feeling of geopolitical uncertainty, the uncertainty about the conflict in Ukraine and the conflict in the Middle East. And if we have, let's hope it's not an armed conflict in the United States, but if we have a contentious election, which I think is a very likely outcome, I think that's simply going to be even further positive for gold. I don't see any negatives out there right now. It's hard to see see where the headwinds might be coming from the gold point of view.
Well, certainly we've got a lot ahead on the calendar. In addition to the presidential election, there's also a Federal Reserve meeting. What assumptions are you and your colleagues making about the Federal Reserve and the pace of further rate cuts?
I think that, Jerome Powell has said explicitly and many, many times that he plans to be driven by the data, and that he's also trying not to be to put too much emphasis on any 1 month's particular set of economic statistics, because these are always open to revision. But if everything stays pretty much the same as we are right now, and he doesn't get any major surprises in the data, then it looks like the market consensus is right. The market consensus has now settled on 2 more 25 basis point rate cuts, one at the November meeting, one at the December meeting, and then a sustained succession of small 25 basis point rate cuts through the whole of 2025 to bring Fed funds rate down to somewhere around about the 3% level, probably a little bit higher than the sustainable normal rate, the neutral rate, if you like, as some of the economists want to call it. But Jerome Powell has indicated if the data keep coming in the way that they are, strong economy, some signs of a little wobble here and there in the labor market, but nothing really dramatic, then that will be the likely outcome. 2 more rate cuts this year, and then a succession of rate cuts next year. And then somewhere toward the end of 2025, the Fed will take a little pause and have another macro view, if you like, the view from 35,000 feet to see exactly where the general economy is and where all the other indicators that they're looking at, especially the labor market. But Jerome Powell has made it very clear that he still wants to see an extended period of below-trend growth, and he has seen nothing like that certainly in the last 12 months, and there are no real signs of anything like an extended period of below-trend growth. That's what he wants to see. So he's not going to rush cutting interest rates at all.
Quick question about demand. You are talking to us from Hong Kong. China and India are the world's 2 top gold consumers. Is the demand story for the precious metal the same in both countries?
No, I think there are very, very different dynamics in each country. We've seen pretty good jewelry demand in China, but nothing outstanding. We've seen stellar investment demand, I think because the Chinese investor is frightened of his stock market right now. India is a very, very different story. What we have in India is that demographics, population growth is definitely on gold's side, with strong population growth there, unlike China. The economic factors are also on gold's side. The Indian economy has been growing. The IMF seems to believe, from the most recent report, I think that India was really the one country that got top marks there. They're expecting 7% economic growth this year, and probably better than that next year. They're expecting the Indian economy to overtake the Chinese economy in size, because the Chinese economy has turned into some decline with the graying of the population. Very much different dynamic from what's happening in India, and of course, we are now well into the Indian wedding season, which will run through until next May or June, depending on where in India one lives, and that has always been very good for an uptick in gold jewelry demand there. But investment demand is also running strong in both countries, and I think it's very important to look at both of those dynamics.
George Milling Stanley, Chief Gold Strategist at State Street Global Advisors. I'm Charlie Pelleton, New York, in for Doug Krisner this week. You can join Doug weekdays on the Daybreak Asia podcast. It's available wherever you get your podcasts. Tom?
And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Tom Busby. Stay with us. Top stories and global business headlines are coming up right now.